Welcome everyone. This is Bob Maurer. It is Saturday, 26th of July, around about 10 o'clock ish my time. And I want to do an update of the current seasonal futures spreads strategies, see how things are looking for the ongoing spread that we had. And then also, I've got one new one to introduce. So let's hop into the portal here. Take a look at where we're at. So this will be for this upcoming week of 7/27. These are the two that we have review here. The first one, 364, the bull spread in gold are flat. We got stopped out. We'll take a look at that one, see how it evolved. And then 364 is a new one in WTI light sweet crude, the October Jan bear spread. And we'll take that one and the entry levels and exit levels. All right, so do it. Hopping over to the charts. First of all, this gold. Okay, so this was strategy 364. It was a bull spread in gold. Gold's been on a pretty good move to the upside, so it looked like things were lining well with the seasonal tendency along with what the actual market was doing. Thing had a pretty good dip for a number of months. Then it kind of stabilized here between about negative 554 and negative 539 ish, give or take a couple ticks. And we got long into the seasonal window, which began July 11, go through August 27. And this thing, instead of rallying, broke pretty hard in a matter of just a few days. So moved sideways at the onset of the seasonal and had a big dip and then a big rally. Okay, so it was a short-lived dip in this particular spread, but unfortunately it caught us. And we got stopped out to the tune of 160 bucks if you were the more conservative entry level, to maybe 480 for a two lot that you averaged into. So not a crazy amount of risk right there, but nonetheless a little disappointing, especially after the big bounce that we saw. Size it up to the actual front leg, the October gold future. Market had been moving. So this is a chart here of the October gold, basically in a range, say somewhere between 3,500 down to about 33 quarter for the October gold futures. And this bar right here is when we started to see the break in our spread. Coincides with right there. Basically saw a big rally, popped to the upside with gold, and then a consecutive break. And that coincided with a big dip in our spread and then a rally. So even though for the most part over the last couple months or so, as you can see, spread didn't budge much, even when gold market was moving within the same range, for whatever reason, decided to go ahead and break out through the downside during our seasonal window here, and it caught us. So none of these trades are risk free. We just try to look for the odds, look for the seasonal tendency as the main driver, but also keep in mind what's going on in the outside market there, or the front legs, the actual market, see if it's a good decision. And in either case, we need to always make sure we have the risk well defined, which we did. But unfortunately, it caught us because we got stopped out with this about 5 ticks from the low. Our stop was at 580, and the low was 585. Double bottom down there. So this one's going to go off our board as a realized loss of some level. And then the new one I want to introduce here, beer spread in crude. So this is strategy number 365. And here, check out the margin requirement, 1,600 bucks, which is pretty thick for a crude spread. So this is indicative that the clearinghouse, in my opinion, is saying that this spread could be a little bit more volatile than normal. That's a fairly substantial move that would be needed to hit that margin amount. Okay, so it's 10 bucks per point. My point is this: that at $1,600 per spread, it'd be a 160 point move that would be required to basically equate to that margin requirement. And yeah, we did see it here. Okay, but this was when the U.S. bombed throwing bombs down in Iran. All right, and that caused that spike. It was one of the reasons caused that spike, and then the market just moderated and softened. We're getting back to normal, but still, it looks like the clearinghouse is saying this could be a volatile spread. So bear that in mind. Entry level risk rewards right here. They look pretty respectable. And then what is going to be the strategy? Okay, we're looking to get shorts. Two levels. Levels 154. Second level is 177. Stop is at 230. And then our targets are going to be down here at 60 and 30. So we'll need to break this white line here, which is 200 period moving average. It's kind of what held it up right here on this little pullback, right? And then we see it bounce about halfway back. So it's going to take a little work to get through that, I imagine. But nonetheless, that's where I have the targets at the moment. And that's what we're looking to do. So this is a bit of a more range bound trade, I'm going to call it, with the spike that we had during this situation here. And then when the market just basically gave it all back for the most part, bounced about halfway back. So I'm thinking that this range in here, area in here, is going to become a sorry about this. There you go. Something like that. That's my suspicions. So we're going to be playing what hopefully becomes this range. We need to see a little bit of a buoyancy in prices and then hopefully a rotation back to the side. That is strategy number 365. And we are looking to get short this January versus October crude oil spread. All right, so that's strategy number 365. And that's where we're at. So we had a bit of a loser in the gold trade. Hopefully, we can get some of that back with crude if things work out okay for us there. And I think that brings everybody up to speed. So if you have any questions, comments, anything of interest, feel free to. I am going watching.